Good afternoon, everyone. Welcome to our 2023 Market Preview webinar. Over the course of the next hour, we'd like to share with you not only our thoughts and summaries of what happened in 2022, but also what to watch for out of the markets and economy as the next 12 months play out. Now, before we jump into the content, the usual logistical and housekeeping items. We are here to answer any questions that are on your mind. Please submit a question using the Q&A feature. We have the full hour booked for today's session. We will spend as much time answering questions as time allows once we've wrapped up our formal remarks. This session will be recorded and uploaded to our YouTube channel. If you would care to go back and watch it again or share with colleagues, it will be available shortly after today's live session has ended. Now, introductions. My name is Greg Leonberger. I'm the Director of Research here at Marquette. I will be the host for this afternoon's webinar. Joining me today are a number of our lead analysts on the research team to talk through their different asset classes. Jessica Naviscus will talk about the U.S. economy. Frank Valli will cover fixed income. Catherine Hillier and David Hernandez will team up for U.S. equities and non-U.S. equities, respectively. We will then move on to the alternative assets portion of the webinar. Chad Schaefer will cover hedge funds. Josh Cabrera will go through real assets, which consists of real estate and infrastructure. Making her webinar debut this afternoon is Haley McCollum, who will cover private equity. Then Brett Graffey will finish up with private credit. Now, as is typical on these webinars, we like to start with the U.S. economy because that's the natural backdrop to all the capital markets that we will be discussing today. Jessica, what did you see in 2022 and what are you watching for over the next year?
Yeah, inflation is still really the starting point at the macro level. The latest read there was the December CPI report that came out last week. December numbers were in line with expectations, a bit less exciting for the market than the better than expected reports the last 2 months, but still good news with year-over-year numbers continuing to slow. Headline CPI was down to 6.5% year-over-year, down from the peak of 9.1% in June, and core CPI was down to 5.7% from the peak of 6.6% in September. Month over month, headline inflation was actually down 0.1%, driven by lower gasoline prices. And even though month over month core inflation reaccelerated slightly to 0.3%, annualized that's still only 3.7%. So we are clearly making progress toward target inflation. The expectation from here is that price pressures continue to ease, with lag metrics like shelter finally expected to show some relief later this year. Despite these higher prices, consumer spending largely held in last year, but it was funded by consumer savings, which is obviously unsustainable. Consumer savings spiked during COVID, with stimulus money coming in and spending down. That corrected throughout 2021 as spending patterns started to normalize, and then in 2022, savings rates hit multi-decade lows as consumers had to use those savings to make up for the fall in real wages. The monthly data moves around, but we did see real personal spending fall to flat in November, which could be a sign that the consumer is finally stepping back. In an ideal world, consumer spending falls enough to take some of the pressure off of inflation and the Fed, but not enough to cause a recession. That's that soft landing Goldilocks scenario. So on to the Fed. So this is what the futures market is pricing in terms of number of rate hikes and the implied Fed funds rate. Consensus is for another 25 basis point hike on February 1st. That would be another slowdown from the 50 basis points at the last meeting in December, and then another 25 basis points at the next meeting in March, taking the Fed funds rate to a range of 4.75 to 5. Then after March, current expectations are for the pause that Chairman Powell has talked about, where the Fed will let the data catch up and assess the impact that higher rates have had so far. Where the Fed goes from there will be entirely data dependent, with that data being inflation, the labor market, and if it's too negative, potentially economic growth. The market is currently pricing in a base case of rate cuts before year end. And while anything can always happen, the Fed has specifically said that cuts are not on the table this year. So that could be an additional risk to markets if that base case proves overly optimistic. Labor market. So while the Fed was initially very focused on inflation, that has somewhat shifted now as inflation has started to correct. The sticking point then became strength in the labor market. Despite the pressures from higher prices, from higher rates, unemployment has stayed too low, meaning it's at a rate that is inconsistent with 2% inflation. The issue there is an imbalance between supply and demand of labor. And this really got out of whack during COVID, We had early retirements, people getting sick, people leaving the workforce for other reasons, and that led to a spike in unfilled job openings. So still today, there are about 1.7 job openings. What that does is create wage pressure. Businesses have to pay more to secure a labor force, and that wage pressure then feeds into inflation. So if you think about the Fed's 2% inflation target, plus productivity gains of 1.5%, which is actually a bit optimistic given recent productivity numbers, but it's a good kind of base case assumption. So 2% plus 1.5% is 3.5%. And that's the level of wage growth that would be consistent with 2% inflation. Nominal wage growth has actually been trending closer to 5%. December's wage growth number, which was released on January 6th, ticked down a bit to 4.6%. And despite other jobs data pointing to ongoing strength in the labor market, this tick down to 4.6 is really what set off the January market rally and brought back hopes of a soft landing. So what this all really boils down to is economic growth. So historical precedent says that when you have to bring prices down this much, when the Fed moves rates this sharply, it triggers a recession. Still vary a bit for this year, but consensus is that the US will see a mild recession this year, with real GDP just slightly negative in the back half and then reverting pretty quickly in 2024. The most compelling case that I've heard so far for avoiding recession is Goldman and their focus on job openings versus the unemployment rate. Their thesis is that, unlike in the past, where the Fed has had to unwind excess employment, which is something that tends to spiral and impacts consumer spending, this time the excess is in job openings. So to the extent that openings can correct without pushing the unemployment rate too much higher, the consumer would overall be less affected and the economy could avoid recession. So if 2023 ends up being a this time is different scenario, that could very well be the reason.
And Jessica, certainly there's some positive developments with some of the trends that really played markets in 2022, particularly slowing inflation and less hikes from the Fed. You used the term soft landing a couple times, and I think that's probably the biggest question. Of course, that's directly correlated to whether or not we go into a recession or not. But I do think general opinion is that if we do see a recession, it's likely in the second half of the year, and it's likely relatively shallow in terms of depth. So hopefully, if we do see one, it won't be too damaging. I think that is the expectation. Well, with that out of the way, let's move to the traditional asset classes. And we always like to link up fixed income first because there's a natural kind of translation from Fed policy to fixed income performance. And Frank, as we saw in 2022, performance was not good. But what's the outlook for 2023?
Thanks, Greg. As you mentioned, last year was not good in terms of fixed income. But it's really a tale of two stories, or a tale of two different years. So last year, the Barclays Ag was had the worst performing year of all time at negative 13%. The prior before last year was negative 2.9%. That was back in 1994. I know there's some people on the call that have been in this business since the 1994, and you probably remember the themes are going to be eerily similar. And that was the negative returns were driven by higher rates. So the Fed pushed short-term rates higher last year in order to fight inflation. Inflation also pushed rates higher along the curve, which led to negative total returns. Spreads also detracted at the margin. So coming into last year, spreads were very tight in both investment grade and high yield markets. Those spreads moved wider throughout the first half of the year as inflation fears entered into people's minds. However, as the rate hike slowed in the back half of the year, spreads tightened and are now trading near historical averages. So the good news is this year, and that good news is bonds are back. After a decade plus of irrelevance, bonds are now in the face of everybody, or in the front of everybody's mind. So all-in yield and fixed income are now attractive. Let's go back and look at the start of last year. Coming into the year, yields on the Barclays Ag were 1.75%. Throughout the year, as mentioned earlier, yields increased. So the aggregate at the end of the year was 4.68%. We've seen yields come in a little bit here in 2023, and now are trading around 4.25%. So while all-in yields are good, spreads aren't nearly as good as they were mid last year. So spreads are now more fairly valued and trading near historical averages. So while it's difficult to predict returns in fixed income, I do think fixed income's in a much better position than it was a year ago. So fixed income really has two roles in your portfolio. The first is to provide income. And as mentioned before, you really weren't getting income in investment grade fixed income prior to last year. So people went out and searched for other ways to generate income in their portfolio, whether it's going to high yield, whether it's going to EM, whether it's going out in duration, or even moving outside of fixed income to generate yield in something like real estate. But now today, fixed income, traditional fixed income is providing that source of income. The other thing is downside protection. With rates as low as they were last year, there wasn't that much room for the Fed to cut rates. But now today, should a recession come, the Fed could step in, lower rates, and provide that downside protection that really fixed income is made to do, and that's provide a hedge to your risk assets. So yields really aren't a great predictor of future returns. Yields really are only equal to the total return if nothing changes. And as most people know, stuff always changes. So there's really three scenarios that could happen in terms of yield and future returns. The one is nothing changes, so you'll earn your yield. The second is really the U.S. enters a recession and yields should fall. In that scenario, your returns and fixed income will be higher than the yields that are posted. The reverse is also true. Should yields continue to rise, you will see total returns lower than the yield. But the good news is that because yields are higher today than they were last year, you do have some income protection to offset price losses. So to wrap up on fixed income, I think there's three real takeaways. One is on the past. Last year was a terrible year for fixed income, by far and away the worst we've seen since the ag's inception. The second, all-in yields are attractive for fixed income, and spreads are more fairly valued. And the third is fixed income is in a better place in 2023 than it was in 2022. You're getting higher yields, so you're generating some income. And second, there's room to cut, which will provide downside protection if you see a market downturn.
Frank, I think your lead in for a prior page was that bonds are back, and that's really the best way to summarize that investors are actually getting paid to hold fixed income. There's meaningful income to be derived for most instruments in the space today, and the expectation is going forward that they really should satisfy those goals of providing liquidity as well as some stability to portfolios should we see more volatility from the equity markets. And speaking of which, we'll start with U.S. equities. Catherine, 2022 was a tough year. But what do you foresee for 2023? And do you see a reversal of any of the trends that really plagued the markets in 2022?
Great, thank you. As I'm sure many on the call are already aware, there was really nowhere to hide in U.S. equities in 2022, as all major indices declined. The fourth quarter, however, did stand out in a tough year, as major indices posted gains during the period. Similar to the third quarter, though, it was a bit of a tale of two halves. To start the quarter, U.S. equities rallied as economic data showed signs of cooling, which was perceived to be a potential signal that the Fed may slow the pace of interest rate hikes. The S&P 500 advanced 11% during the first 2 months. In December, however, a strong labor market reignited volatility as the Fed reinforced its stance to fight inflation and slow the economy. The potential for higher rates for longer weighed on U.S. equities, with the S&P 500 declining 5.8% during the final month of the year. Despite a tough close to 2022, the fourth quarter was the only positive quarter for the year, as the S&P 500 advanced over 7%. Looking back on 2022 as a whole, the S&P 500 saw notable volatility, posting the third most moves greater than 1%, only behind 2002 and 2008. Interestingly, the sharpest positive and negative moves during the year occurred on days of the CPI release. Looking at small caps specifically, 2022 was the third worst yearly return for the Russell 2000, also only behind 2002 and 2008. So looking at sector performance, within the index, 9 of the 11 sectors advanced during the quarter, with the consumer discretionary and communication services sectors the only 2 sectors to decline during the fourth quarter. As has been the case for much of 2022, the energy sector led during the first quarter, advancing 21%. Following a brief reprieve growth in the third quarter, value returned to dominance to end the year, as small cap equities also underperformed their larger counterparts. This moved back in trend with the year overall. Additionally, the most expensive stocks struggled during the fourth quarter, ending the year down over 40% for the S&P 500. Now looking at active managers and how they performed in this market environment, value managers performed relatively well in 2022, but active growth managers noticeably struggled. A couple of factors may have contributed to the underperformance for growth managers. First, a number of active growth managers outperformed entering 2022, especially those with overweights to longer duration growth companies. These companies were hit the hardest by multiple compression on the back of rising interest rates, weighing on their performance. Second, especially within small caps, the Russell rebalance created some headwinds as the weight of the energy sector increased following the rebalance. This acted as a headwind for many growth managers that have historically carried either no weight or a persistent underweight to the energy sector. Looking at valuations, from a valuation standpoint, large cap equities appear reasonably priced at the moment, while small cap equities continue to look particularly attractive. Additionally, despite recent value strength, as we saw the Russell 1000 value outperform the Russell 1000 growth for the first time since 2016, value continues to look relatively attractive. And now, hopefully, to touch on maybe a slightly more positive note, in the year following negative returns like we saw in 2022, for the S&P 500 and the Russell 2000, markets have averaged a positive return in the following year. In fact, when the market has declined more than 3%, the Russell 2000 has yet to post a negative return in the subsequent year, while the S&P 500 has only stumbled in the tech bubble. A similar pattern can be seen in the year following peak inflation, which many will say likely occurred in 2022. So this degree of outperformance that we might expect in this year may be too rosy a picture to paint, though, as there is still likely to be some volatility in the first half of the year. Following a brief resurgence in December, the VIX did move lower over the quarter, but still settled above long-term averages to end 2022. To start 2023, markets saw volatility decline early on based on economic data, but earnings growth remains under some pressure amid macroeconomic uncertainty and tighter monetary conditions, as earnings estimates for the S&P 500 for 2023 were revised lower in the fourth quarter. So to end, while pressure from interest rates increases and downward earnings revisions has seen the equity risk premium come under pressure, U.S. equities still may be positioned for a recovery as interest rates normalize potentially later in the year, especially if we have seen a rebasement of valuations and earnings forecasts.
And Catherine, I'm going to lean a little bit on the phrase later in the year. I think most expectations are that it's going to be a fairly choppy first half of the year. And as we said to clients really over all the fourth quarter, that just when the clock flips from 2022 to 2023, a lot of the macro factors, which really troubled markets throughout the year, whether it be high interest rates, inflation, possibly of a recession, or Russia-Ukraine war, those are all present today. Now, like we said earlier, some of those start to be fading a little bit, but they will still persist well into this year. And I think really the expectation is perhaps for the second half of the year, those will be smoothed out a bit more and provide for a further upward trajectory across equity markets. So that's the U.S. side. David, the non-U.S. side really saw a similar pattern. I know there's some nuances and some differences between the two. So maybe take us through what happened in 2022, some of the explanations for that, and then what you're looking for in 2023.
Yeah, so we'll do that. Let's review some of 2022. And I think the first place to start is that it was a very, 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 very tough year for global equity investors. Most indices were down anywhere from 15 to 20, 21%. And I think what's especially wild about some of those numbers is we saw a significant rebound in the fourth quarter. So if it wasn't for that fourth quarter, numbers would have been much worse in 2022. So thank you, fourth quarter performance. In thinking about active managers last year and the performance, it was a tough time for active managers. So if you're a non-U.S. equity investor, not only did you have a rough time from an asset class perspective, but likely your active manager also struggled. Only 33% of international large cap and international small cap managers beat their benchmark. Only 31% of emerging market active managers beat the MSCI EM index. So a question could arise, why was it so tough for active managers last year? think one of the key reasons why it was a challenging for active managers was the factor environment was very unique last year. If you think about quality and growth, these are two very common traits that active managers use to identify investment opportunities. And these two factors were the worst performing factors last year. In comparison, value and yield did really well in 2022. I think one of the other additional reasons is markets were uber focused and trading based on macroeconomic data, inflation points that data points that came out, as well as news around geopolitical issues. Certainly Russia's invasion of Ukraine at the start of the year, and then news out of China as we move through most of 2022. So those things really made it a challenging environment for active managers. And when we look forward and think about the future for active management, we think that once the markets shift their focus and start to pay more attention to fundamentals as well as earnings, that should be helpful for active management performance. Now, speaking about earnings, despite the significant negative returns we saw from non-U.S. equities, earnings were roughly flat to positive in 2022. And if we break down the components of return, both earnings and dividend were additive, where they were positive last year for the ACWI ex-US. In comparison, currency and valuation compression were the key reasons for the losses last year. Now, price multiples dropped significantly as investors were concerned about the economic and geopolitical environment. Additionally, currencies detracted 6% last year, and at one point they were down more than 10%. We saw a rebound in the fourth quarter, but the dollar was strong for most of 2022. Now, while valuation and currency, if you look at this chart, have been detractors the last 2 calendar years, when we look forward, we think that there's a possibility for them to serve as tailwinds for non-U.S. equity investors. Now, the dollar strength in 2022 was the direct result of an aggressive Fed who hiked rates much faster than markets expected and much faster than their other counterparts in the rest of the developed world. And as Jessica spoke about earlier, inflation starting to taper off, investors expect the pace of rate hikes to slow down significantly. And they also expect higher rates from countries within Europe, as well as Japan. And so that narrowing gap of the rate differential bodes well for dollar weakness. And that dollar weakness can serve as a tailwind for non-U.S. equity performance. Now, one of the challenges that's related to the rate hike environment is the potential impact it may have on economic activity. We've seen GDP forecasts across the globe drop significantly over the last 12 months, and higher rates typically lead to slower economic activity. So one of the key risks and key questions for 2023 is, can central banks continue to address inflation with higher rates while avoiding a major recession? Now, the risk of recession isn't a new topic. This came up in 2022, and it certainly has weighed on markets. And it's been a key reason why we've seen price multiples fall through most of last year. Now, while valuations across the equity landscape have come down, I think the non-U.S. space has been especially hit. And as a result, I think there's an interesting valuation story there. If we compare non-U.S. equities to the S&P 500, non-U.S. equities are now trading at near or below their all-time lows relative to the S&P 500. And this is both for trailing as well as forward price to earnings multiples. We think this is supportive for non-U.S. equity performance relative to the S&P 500 over the next 3 years. One of the other strengths for non-U.S. equities currently is dividend yield. If we look at the universes within non-U.S. equities, more companies have a dividend yield of 3% or higher. And if you take the average dividend yield of the index, it's nearly double that of the S&P 500. So dividends also are supportive for non-U.S. equities. So to wrap things up, just framing things in terms of risk and opportunities, there's something that I haven't talked about yet, and that's China's reopening. And we would consider this both a risk as well as an opportunity. From the risk perspective, China's reopening should lead to more economic activity. And I think there's some concerns about what that does to prices, what that does to demand. Will that push inflation higher. While inflation has come down, that's still a risk. If we see an uptick in inflation, that's going to really spook markets and probably lead to some poor returns within the equity space. Another key risk, geopolitical. We talked about this in 2022. This will be something that we'll pay attention to in 2023. China-U.S. relations is probably one of the key ones to monitor. From an opportunity standpoint, the valuations in non-U.S. are attractive. We think that's supportive for 3 to 5 year returns from here. We also think that the conditions within the currency environment are beginning to be supportive and that there can be a switch. There may be a switch from dollar strength to dollar weaknesses. Dividend yields are higher in non-U.S. equities. So in a year where returns may be a little bit tough, dividends may become more important to investors. And then the China reopening, a risk, but also a positive in terms of potential economic activity that can flow into the rest of the world.
Thanks, David. And what really jumps off the page here in terms of opportunities is the attractiveness of valuations coupled with higher dividend yields. So even if we saw more price volatility and price drops, the higher dividends can help offset some of those price losses. And to me, I think that hopefully equates to a positive year out of non-U.S. equities in 2023. But the 800-pound gorilla in the room, so to say, is really geopolitical tension and what that looks like over the course of this year. So that's the end of the traditional asset class discussion. We're moving now over to alternatives. We'll start with hedge funds. And Chad, the floor is yours.
Great. Thanks, Greg. So as my colleagues noted, the fourth quarter saw equities rally for most of that period before giving back a portion of those gains in December as risk sentiment turned decidedly negative. Hedge funds, though conservatively positioned coming into the quarter, were able to participate in that rally to a degree, generating positive returns. Now, this was led by equity hedge funds up about 4%, while the broader HFRI composite was up 2.2% over that period. Now, it's important to note that hedge funds actually held up well in December, which saw the S&P 500 decline nearly 6% for the month. The HFRI composite was down only about 40 basis points in December, and equity hedge funds captured only a fraction of the declines in the equity market, down less than 1%. Now, for the full calendar year 2022, macro hedge funds were clearly the standout. They posted a positive 9.3% return, and managers were able to capture a number of the significant moves we've talked about, driven by the macro and geopolitical risks that investors faced for the year. Now, on the other end of the spectrum, it's been more challenging for equity hedge funds, with the HFRI Equity Hedge Index posting a decline of 10.4%. Now, for context, that's only about 57% of the decline the S&P 500 saw, around 18.1%. So while results were definitely disappointing, equity hedge funds did help to limit that drawdown to a degree. Now, given some of these challenges, the next few slides will focus on some of the key trends we've seen for equity hedge funds and some of the context that would help us look forward to 2023 and hopefully a more positive backdrop. Starting with leverage, we've seen gross and net exposures decline throughout the year as managers have become increasingly conservative amid the volatility and significant declines we've seen in equity valuation multiples. Net leverage did tick up a bit in November as managers began to cover shorts during the equity market rally, but this reverted again lower heading into the end of the year. Gross leverage also declined in December and now sits at multi-year lows, highlighting just how conservative hedge fund managers are positioned as they await more of that clarity and as we expect more bumpy and choppy roads here in the first half of 2023. Turning to performance on the long short side, we saw significant alpha generated in shorts in December, while names on the long side lagged the broader market, a trend we saw through the entire 2022 calendar year. Now, hedge funds did a relatively good job on the short side all year long, but again, that long exposure is the majority of the exposure, and again, it underperformed broader equities for the year. Now, it's certainly been challenging, but some of the go-forward takeaways is that the environment is shifting towards a better situation for stock pickers, and there's a number of reasons for that. And I'll just highlight one of those on the next slide, and that's short rebates. In order for a hedge fund manager to short a stock, they must first borrow that stock from the street and subsequently post collateral against it. Now, the borrowers, in this case, the hedge fund managers, are entitled to any return earned on their collateral, net a nominal fee of typically 25 to 50 basis points. Now, this return on collateral is referred to as the stock loan rebate or short rebate, which is highlighted here, proxied by short-term interest rates. Now, if you look at the chart, this has been a low returning and even negative rate for much of the past 10 years. It's been lower than the equity dividend yield since 2009, meaning that the cost burden to actually short equities has been pretty high for hedge fund managers. especially those that pay dividends, where you have to pay that back to the street where you're borrowing from. So in other words, this is an added hurdle that hedge fund managers have had to overcome on the short side to generate attractive positive returns. Now, with the rate hikes we saw in 2022, this picture has shifted significantly, and returns on cash collateral are now positive and above the equity dividend yield. So in effect, what this means is that the cost burden to short stocks is now much lower than it's been for much of the last decade. And combined with an environment that will likely see continued dispersion and uncertainty in equities, but also in credit for that matter, this sets up as a more positive backdrop for long-short funds going forward to deliver alpha, but also to drive returns for investor portfolios. Now, to wrap up my comments on the next slide, I thought it'd be helpful to take a look at hedge fund performance in the context of recessions, both during recessions and in the periods following that. Now, again, past performance is not an indicator of future results, but with the likelihood of recession increasing, my colleagues talked about this in a number of their areas, it's helpful to see how hedge funds have behaved in those periods. So on this slide, you have a number of different hedge fund sub-indices highlighted in blue. And then this is compared to traditional equity indices and fixed income, highlighted in green and orange, respectively. Now, on the left, you have average performance during each of those recessionary periods. Those recessions are defined by the National Bureau of Economic Research, and it dates back to 1990, which is when hedge fund data typically starts. On the right, you have the average 12-month returns for each of these indices following that recession. So as you can see, hedge funds have historically done a good job, on average, providing diversification and downside protection during recessionary periods when investor portfolios need it most. But perhaps more interestingly is if you look at that 12-month period on average after those recessions, where hedge funds have actually outperformed both equities and fixed income over those periods. So again, we can debate whether or not we'll end up in a recession. The data points to a mild recession. The degree of that recession can be argued and debated by economists. But the fact of the matter is hedge funds are generally well positioned to provide both that ballast to investor portfolios in those tough times, but also to potentially outperform in the recovery following those recessions.
And Chad, the reality is that we don't know till well after the fact what the actual period of the recession is and when the recession is ending or entering into that 12-month post-recession period. But the good news is that hedge funds appear to do a good job protecting principal during the recessions, and after outperformed. And quite honestly, I was a bit surprised by the degree of outperformance versus equities in particular. So hedge funds up here poised to really deliver on some of the premises that they're based upon of principal protection as well as providing upside protection. So that's hedge funds. Now let's move over to the real asset side, and we have both private real estate and infrastructure. And Josh, curious to hear kind of how some of these macro factors we've heard about a lot already, how they've impacted the asset classes, not only looking backwards into 2022, but also looking forward into 2023. So I'll pass it to you for these two sections.
Awesome, Greg. Let's start here with performance. Commercial real estate performance has started to moderate from rolling one-year highs at the back half of 2022. Prelim performance was down another 5% in the fourth quarter as investor demand has pared back in response to higher yields and a less favorable outlook for economic growth. However, we do expect a greater proportion of the Odyssey universe to report negative appreciation and longer wait times for redemption queues in Q4, given the rapid repricing across property sectors in today's environment. Higher interest rates, liquidity challenges, and inflation will continue to put downward pressure on near-term pricing and transaction volume. Shifting gears here, let's look at the deal flow activity. The increasing cost of capital should negatively impact deal flow and pricing in the first half of the year. Lending activity from institutional banks will continue to slow as there is currently less financing and available dry powder for investors, especially for underlying office deals. Volume declines were prevalent to end last year, with transaction activity down over 20% from prior year. The market is now in an adjustment period that will take time to play out. Although industrial and multifamily volumes are well ahead of historical norms, sales are expected to be muted again to begin the year. One area of optimism is the retail sector, where most investors are expected to be one of the major performing sectors in 2023. Retail cap rates have been the most resistant relative to the other core sectors, suggesting less pressure and higher resistance from rising interest rates. Focusing now on rental income generating at the sector levels. Overall rent growth, albeit still positive across most property types, has started to slow within each property type except industrial. The pricing power of real estate as an adequate inflation hedge will be challenged going forward, as the ceiling to reset rents to market levels may be pushed downwards from higher debt costs and debt service coverage ratio shortfalls. The historically tight market conditions and aggressive competition for space drove another strong quarter for rent growth for the industrial sector, as rent growth topped over 12%. Yet this is still a far cry from the excess 20% rent growth in 2022. Even multifamily NOI growth slowed to a meager 5.7%, as rents declined in December for the fourth consecutive month. Surprising to no one, office rents held steady at a modest 1.2% growth, but lease concession packages remained generous. However, there is still some semblance of tenant demand in Class A properties in dynamic growth markets. Moving on to infrastructure. Lagged infrastructure performance continued to regress in the second quarter, declining by another 1.3% within the broad private market index. Market volatility and tighter borrowing criteria from interest rate hikes are currently impacting private market deal flow and valuations. Unclear central bank policies, rising commodity prices, supply chain disruptions, and geopolitical conflicts continue to be headwinds for the asset class. However, supportive legislation in the form of the Biden bill and the Inflation Reduction Act should increase investments towards the energy transition in line with future infrastructure demand. Finishing things off here and shifting towards a clean energy transition. Traditional energy companies are increasingly focused on achieving a pathway to net zero emissions by 2050. Transportation and logistic assets are positioned to leverage accelerated fleet electrification, new forms of mobility, and alternative fuels over the medium term. Global decarbonization efforts over the next 3 decades will require a $100 trillion investment. These regulatory measures are expected to have a positive impact on renewables, clean infrastructure, and digital broadband technology.
Thanks, Josh. And this slide certainly suggests some longer-term momentum and support for infrastructure as an asset class. And circling back to the real estate discussion, I think most investors who have had real estate in their portfolios for a considerable amount of time have gotten used to kind of the typical return and risk profile of real estate. And fourth quarter of 22 and the first couple of quarters of 2023 will probably be a departure from what they're used to in terms of the returns they've seen. But longer term, we think these trends play out over the next 1 to 2 years as the market kind of resets and expect more a resumption of the typical return risk profile of real estate. But it will be a bit of departure over the next, let's call it 6 to 12 months for what investors have typically been accustomed to. So moving out of real assets into private markets, we have both private equity and private credit to cover. Private equity is up first, and Haley, I'll let you take it from here.
Thanks, Greg. And before we review private equity performance, just a reminder that private equity performance is lagged. The numbers listed on this slide are as of 3Q 2022. So as you can see, overall, global private equity and global venture capital were down in Q3. Global private equity was down about 1.8%, and global venture capital was down about 1.9%. You can see on the charts, private equity has still outperformed a majority of public market indices on a 1, 3, 5, and 10-year basis. For private equity returns in the U.S. to avoid further markdowns in 2023, it's going to require a soft landing where the Federal Reserve is able to reduce rates, which will support liquidity and financing, ultimately driving private equity performance. Even though private equity is experiencing a pullback in performance, fundraising levels has still held up. Private equity managers in the U.S. have raised an estimate of about $260 billion across 296 funds through September 30th, which is on par with 2021 peak levels. Looking towards 2023, the fundraising environment is expected to be more challenging because many LPs are faced with a lot of re-ups or they're experiencing the denominator effect, which is causing them to be overweight private equity. Now, every downturn is different, but historically, when there's a pullback in the market, private equity has experienced a quicker and less severe recovery. You can see this illustrated on the graphs. On the left is the dot-com crisis, and on the left is the global financial crisis. Also, during times when the market has pulled back, it's created great buying opportunities within private equity. So venture capital exit activity and total exit value has been down compared to 2021 highs. This is mostly caused by the decrease in the number of IPOs. Despite a decrease in exit activity, as the 22 numbers start to materialize, 2022 is looking to set record levels for fundraising. Majority of the capital that's being raised is being raised by larger late-stage funds. So while navigating the current environment, it's important to prioritize early-stage managers who typically have more options of exit than just an IPO, and also are typically bought by late-stage venture capital firms.
Thanks, Haley. And a couple points to make as we summarize private equity. That certainly there's been a step back in performance, consistent, not in magnitude, but at least in trend with public markets. But the important thing with private equity is that these are long-term investments, which are illiquid. There's a lot of vintage year diversification. So we encourage investors not to overreact to short-term performance, particularly in the private equity space. And then as you showed on the slide prior to this, is that private equity is shown to be pretty resilient in times of market downturns. And there's no reason to think that won't be the case as the rest of this year and future years play out as well. We've got one asset class left, and that's private credit. And Brett, private credit, as a result of what happened in rates, we saw some new developments there in terms of not only performance, but also future opportunities. So I'll stop talking here and let you take us through private credit.
Thanks, Greg. And as you'll see, going through private credit, talking about performance, the opportunity set, a lot of the same themes ring true as they do on the private equity world as well. So once again, reporting on a lag basis, private credit finished up 1% in the third quarter of 2022, exceeding all public fixed income and equity indices except for the Credit Suisse Levered Loan Index, which had trailed slightly by 20 basis points for the quarter. Similarly, if you look across the 1, 3, and 5 and 10-year time periods, private credit has bested all public fixed income and equity indices except for the Dow Jones Industrial Average and the S&P 500. Overall, the return and yield premium achieved by investing in private credit remains as a return driver and a risk mitigant for the asset class in an institutional quality portfolio. In 2021 and 2022, inflation emerged as a top threat to investor portfolios, but private credit has proven to be a protection against rising inflation rates. The floating rate nature of these loans means that investors can be protected if inflation causes short-term interest rates to rise. SOFR, which is the floating rate component of private credit, has risen nearly 525 basis points over the past year. Additionally, credit spreads have widened on average around 100 to 150 basis points over that time period, providing private credit loans today with an all-in yield of nearly 10%. Continuing to provide investors with strong income, but also a hedge against those rising inflation rates. Floating rate loans are highly likely to outperform fixed rate bond allocations in a rising rate environment like we have been experiencing over the past year or so. While the increased yield on private credit is welcome to investors, it can come at the expense of the underlying company and its liquidity profile. Many questions we have received from investors as of late center around at what level do we consider SOFR to be too high at the detriment of the company? Looking at the data over the past year, we can see that interest coverage ratios have fallen nearly 33% as SOFR has risen over 200% over that same time period. The falling interest coverage ratio is a product of rising SOFR levels and the impacts of inflation on a company's top and bottom line. That being said, interest coverage ratios are not yet at a level that cause panic among private credit investors, but rather a trend to watch carefully. Additionally, history has shown, particularly through the COVID pandemic, that lenders can be amenable to altering terms in periods of distress to ensure that companies can still meet their demands, and investors can still achieve strong returns.
Thanks, Brad. And for all the carnage left behind in 2022 because of higher rates, certainly there's a more attractive opportunity set as we begin 2023, really across capital markets, and private credit is a great example of that. We're at the conclusion of our prepared remarks, and a reminder for the audience that if there are questions you have, use the Q&A feature on your screen to submit any question. And we've actually received some questions ahead of time from a couple internally from some of our consultants who naturally source these questions from their clients. And then we had a large event yesterday in which we hosted a bunch of investment managers, and there are some questions they had as well. So we thought we'd put together a collection of questions to get the conversation started. And like I said, we have the rest of the hour to cover questions. So these are in no particular order, and I'm just going to go down the list here. First one is, how's China's volatility affecting how active managers are thinking about positioning? David, this sounds like a question for you in international equities.
Yeah, so China has been extremely volatile. It's been one of the most volatile markets over the last couple of years. Really strong performance in 2020. Then you saw some underperformance relative to most of the rest of the world in 2021 and 2022. So it's been quite a dynamic market. It's a big part of the emerging market index. I think at its peak, it was somewhere around 40%. It's probably closer to 30% now. Most active managers, there's going to be some at the edges that are taking large bets on China, but most active managers think about it from a risk perspective, a risk management perspective. And that's risk both to the upside as well as the downside. So what that typically means, I think, is, and what I've seen is that most managers are cognizant of their exposure and don't want to be too underweight and don't want to be too overweight. And it's interesting to see, because I think in the month of November, China was the strongest market out there and was up 30%. And that's an example of how quickly things can change within that country, especially given that sentiment was so poor against it. So any positive news, surprise is going to lead to some big returns. So final answer, people are taking a risk management approach to it in general and are fairly close to the benchmark, both a little bit up and a little bit down.
All right, thanks, David. Next question. M&A activity significantly slowed in 2022 as increased borrowing costs had a significant impact on deal flow. What are the expectations for M&A activity in 2023 for event-driven strategies? Chad?
Yeah, so there's a couple of things I will point out here. First, it's true that M&A activity declined in 2022, but that was also off record levels in 2021. So that, no doubt the record levels were fueled by a low interest rate environment, making it easier to get deals done. But if you look at merger arb strategies, they actually posted gains for the year in 2022. So, a lot of those deals were in the first half of 2022, and there was a significant slowdown in the second half. But deals were still getting done, or also moving through the different hurdles as they kind of work towards consummation. But now, if you look at 2023, I think you'll still see that slowdown from the second half of last year continue forward, at least in the first half, until we get a better sense of the economic environment, where rates are going to go, just how costly is it going to be to get deals done in the M&A world. But there's also an engine in some of these industries where they need to reignite growth, and M&A is a huge part of that. So I think you'll see M&A pick up in certain areas, especially one that comes to mind is pharma and life sciences. There's a significant wall of patent expirations for these big pharmaceutical companies that's coming to expiration over the next few years. So these companies need to source new revenues, new growth. And the only way to do that really is to acquire it via life sciences and biotech. So I think you'll see pockets where it picks up more quickly than others, but I do think you'll see it more broadly in the second half of the year.
Seems to be kind of a consistent theme with a lot of things. Second half of the year is when some normalcy might return to a lot of the markets that we cover. All right, next question. Considering the number of macro headwinds affecting core real estate investors, where can institutional investors seek refuge to earn risk-adjusted returns? Josh, I think this one's for you.
Yep, that's a great question. Fundamentals across industrial and multifamily sectors in cities with dynamic job and population growth remain strong. as occupancy levels remain high and rental growth is still positive across the in-favor sectors. Despite the capital market volatility and the resulting denominator effect across institutional portfolios, certain segments within real estate remain more attractive. Investments in opportunistic equity, bridge financing, and secondary market transactions in 2023 should provide avenues to earn risk-adjusted returns. Timing of entry into this market is heavily dependent on the duration of the current valuation cycle and the visibility towards the completion of the Fed's tightening cycle as it relates to interest rate hikes.
Looks like another question on M&A. Given the lower M&A volume relative to 2020 and 2021, how has deal from and quality of deal flow been in the private credit space?
Yeah, absolutely. Good question. No doubt that overall M&A deal flow is slowed significantly. That being said, talking to most of our managers, we're seeing overall deal flow from 2021 and 2022 down anywhere from about 30 to 40%. That being said, the quality of deal flow seems to have increased as just the number of players in the space and the willing market participants to take on the risk of lending in this volatile environment has decreased. So as I mentioned earlier in my slides, overall credit spreads have increased, which at the end of the day should benefit investors and lenders. So while as overall deal flow has decreased, I would say overall this is a lender-friendly environment with lender-friendly terms and so forth. So the quality of deal flow has increased slightly. So it seems to be a pretty prime environment for lenders in the space today.
Next question, in this benign credit environment, what is the view on downgrades and defaults? Frank, you want to take it?
Sure. Thanks, Greg. I think it's important to start by talking about what the benign credit environment has been, and then we'll talk about what things are anticipated to be in the future. So long-term averages in defaults and below investment grade space are around 3%-ish. So if you look back, 2021, 1% defaults were realized. 2022, 2%. So going forward, that needs to definitely pick up. So the forward-looking trends over the next couple of years are ticking up from that low level, but they're still not egregious. So we're still looking at long-run averages are anticipated in both 2023 and 2024. Right around somewhere between 3 and 3.5%. A few things fueling that, macro headwinds. I mean, that's really the big thing that's causing this uptick. You're seeing inflation, higher rates, slower economic growth. There is a little bit of an offset. Most of these companies have termed out their debt. There's not an upcoming maturity wall. There's limited near-term maturities. So that's kind of the tailwind and balancing things out to make things pretty average over the next year or two.
And you touched on something in your answer, which I think bears repeating, that when the inevitable headline comes up of default rates tick up, downgrades are increasing, it's coming off such a low base and they're still below the long-term averages. So even as they tick up, as they approach long-term averages, they're not even at long-term averages yet. And I think the expectation, Frank, is that they'll probably settle in at those long-term averages. Is that correct?
That's right. I mean, we're looking at getting back to average, and the good news is you're still getting paid. So you got to remember, high yield and loans today, well, maybe not today, well, at least at year end, we're 9% plus yield to worst. So the yields on those assets are attractive, particularly given just a modest or average anticipated default rate.
Thank you. Next one, where do you see opportunities within U.S. equities this year? Catherine?
Yeah, so I like to think I'm a fairly positive person, but as we have discussed through much of this call, there will likely be quite a bit of volatility in the first half of the year still for U.S. equities for all the reasons we've already discussed: economic data releases, questions of if and when the Fed shifts to a more dovish stance, to what extent we might see in a recession. Some of those signs have started to come through in the past couple of days with retail release reports and earnings releases starting. But understanding your investment goals, I think, is also pretty key in this sort of environment, and staying the course through this volatility. it remains pretty key. It's been shown in the past that missing the best days in the market can have a dramatic impact on performance because it's extremely difficult to time market movements in these volatile times. So with that said, if I had to pick a spot for the year overall, I think small cap equities still look quite attractive. There might be some tough days ahead, as I've mentioned, although hopefully not quite as extreme as we saw in 2022. But they are well positioned, I believe, to recover as the macro backdrop stabilizes. Another thing I might note is active management. I think as you've seen sort of the dominance of the big five and large caps sort of wane last year, and you've seen sort of sector performance diversify a bit more and industry what's driving market performance diversify. I think you might see some positive signs from active managers this year as well.
And I'm going to put out a call for one last offline question. I have not seen any other ones come in. We'll certainly go through this one here. How has the rise in rates impacted deal activity in private equity? Haley?
Yeah, great question. So higher interest rates have definitely caused deal activity to slow compared to 2021 highs, but deals are still happening and consistent with historical levels. We expect this trend to continue throughout 2023.
All right, we'll take one last peek and no other questions come in. So let's wrap up. First and most importantly, thank you for spending the last hour of your day with us. We hope this has been helpful as you and your committees and your organizations think about 2023 and investment strategy and what to expect out of the markets. We're all eager to put 2022 behind us, and hopefully 2023 is better news ahead. Certainly, I think one big takeaway across asset classes is that, yes, a lot of these headwinds, the macro headwinds that troubled markets in 2022, they still remain. But given what happened in 2022, there's a fairly attractive opportunity set across asset classes. And the thesis, of course, is that delivers more positive returns in 2023. All that said, if you do have further questions, you can use the email address listed here, research5@marquetteassociates.com, to submit any questions. And then depending upon the topic, the appropriate person will get back to you. We're happy to answer anything and everything that's on your minds. Again, thank you. Happy New Year. Enjoy the rest of your day.